Hey guys, so you would have heard the headlines. After talking about it for years, it's finally happening. India's two biggest power sector lenders, PFC and REC, are being merged to create one financial giant. But what people might be missing is the real investment angle to it. This isn't just a corporate headline. It's a massive government move tied directly to the Viksit Bharat vision. But behind all the big talk and the billion-dollar numbers, the real question for you is, what does this mean for an investor? Is this the start of a new multi-bagger? Or is this just a complex government play filled with risks? See, you're putting your own hard-earned money on the line. Don't listen to me, don't listen to anyone. Understand the logic. Today we are breaking down this entire PFC REC merger. We'll look at the government strategy, the numbers, the huge regulatory problems, and most importantly, what you need to understand before you make any investment decision.
Okay, so first, let's quickly understand who the players are. PFC and REC are not your everyday companies. They are the financial backbone of India's entire power sector. Think of them as giant specialized banks that give out the huge long-term loans needed to build everything from power plants and transmission lines to village electrification projects. For years, they've operated as two separate but very similar giants. So why merge them now? The answer came straight from Finance Minister Nirmala Sitharaman during the 2026-27 Union Budget. The stated goal is to achieve scale and improve efficiency to handle the crazy growing credit demands of India's power sector. Now, this is the core of the strategic vision. Let me help you understand the thesis of this. India's economy is supposed to grow and our need for electricity is exploding with it. To power this growth and fund the big shift to renewable energy, the country needs a lender that is bigger, stronger, and more efficient. The government is betting that by smashing PFC and REC together, it can create a single entity that can write bigger checks, borrow money at a cheaper rate, and get rid of all the bureaucratic nonsense that comes from having two organizations doing the same job. This isn't just about making a bigger company, it's about trying to build a financial engine powerful enough to fund the nation's massive infrastructure goals.
Now, if this whole story sounds familiar, you're not wrong. This merger has been on and off the table for almost 7 years. The first big move was way back in March 2019, when PFC bought a 52.63% controlling stake in REC from the government for about 14,500 crore rupees. That deal basically made REC a subsidiary of PFC. The plan was always to do a full merger, but it hit a massive wall. For years, the whole thing stalled and they just stayed in that holding subsidiary structure. The main reason for this delay was a complicated mess of regulatory problems, which we'll get into in a minute because it is still the single biggest risk factor today. What makes this new announcement so interesting is the whiplash. The budget announcement proposing the restructure happened on February 1st, 2026. Just 5 days later, on February 6th, the boards of both companies gave their in-principle approval for the merger. This sequence of events strongly suggests this was a top-down mandate from the government, basically telling the companies to get it done and align with the bigger Viksit Bharat vision, whether they were ready or not.
To really get the scale of what's being created, we need to look at the numbers. This is the creation of a true financial behemoth. As of September 2025, reports showed REC's loan book at a staggering 5.8 lakh crore rupees, with PFC's not far behind at 5.6 lakh crore. When you combine them, you're looking at a loan book of well over 11 lakh crore rupees, creating a lender for the power sector that is just unprecedented in scale. In terms of market value, recent figures put PFC's market cap around 1,37,500 crore rupees and REC's at about 1,06,000 crore. But here is the critical point. Both companies have been trading at very, very low price to earnings or PE ratios. PFC's PE has been in the 4 to 5 range, with REC's around 5.8. These are numbers you typically see for companies that the market perceives as either slow-growing or carrying very high risk.
The hope from the government side and from any long-term investor is that a merged, supposedly more efficient entity with a stronger balance sheet and a central role in national development could finally trigger a re-rating and push these valuations higher.
This brings us to the most important part for any investor. What are the potential upsides and what are the very real risks? Okay, let's break it down. First, the potential positives. The big phrase everyone is throwing around is operational synergy. This is corporate bolwachan for eliminating waste. With a full merger, you can get rid of duplicate departments, a parallel due diligence process for the same projects, and layers of administrative costs. In theory, this should lead to higher efficiency and better profits. Second, a single massive balance sheet makes the new company financially stronger. This lets it borrow money from the market at cheaper rates and allows it to fund much larger infrastructure projects which are critical for India's energy transition goals. This could unlock a new wave of capital for renewable energy, transmission and distribution projects. But now, we have to talk about the risks, and they are significant. The number one risk, the same one that stopped the merger back in 2019, is the RBI's exposure limits. In simple terms, the RBI has rules that stop a lender from putting too many eggs in one basket. You can't lend too much to a single company or a single project. As two separate companies, PFC and REC could both lend to the same big power project, effectively doubling the available capital up to a limit. The problem is, a merged entity is treated as a single lender. This means for many existing loans where both companies have lent money, the combined exposure could blow past the RBI's cap. Figuring this out will be incredibly tricky and might require special exemptions from the RBI. The success of this whole merger could literally depend on how this regulatory knot gets untangled. The second major risk is execution. Merging two enormous government-controlled financial institutions is an unbelievably complex job. There's a real risk of integration challenges, culture clashes, and delays that could disrupt their operations and eat away at any of the expected benefits. The market is cautious for a reason. Finally, there are huge uncertainties for shareholders. If you're a minority shareholder in REC, the swap ratio has not been announced. This ratio decides how many shares of the new company you get for your REC shares, and it will be the ultimate factor in whether this deal is good for you financially. On top of that, we have no idea what the dividend policy of the new entity will be, which is a critical factor for anyone investing in PSUs.
Before we get to my final verdict, a quick request. We spend a lot of time analyzing complex topics like this to bring you clear, actionable insights. If you're finding this breakdown valuable, please press the like button and subscribe. It helps your growth also, right? You would understand economics and finance in a much more holistic, practical manner. So, what's the final takeaway for an investor? Okay, listen, the PFC REC merger is not a simple stock story. It is a strategic, long-term government play on the India growth narrative. The government's objective is crystal clear: forge a financial titan that can bankroll the country's multi-trillion-dollar infrastructure and energy goals. The long-term bull case is there. If the merger is smooth, if they actually realize these synergies, and if the regulatory hurdles are cleared, the resulting company could be more profitable and strategically vital. This could lead to a significant stock re-rating over time as the market starts valuing it less like a boring PSU and more like a critical financing institution. However, the short to medium term is just clouded with uncertainty. That regulatory issue with the RBI is not a minor detail. It is the central challenge that will make or break this merger. Execution risk is very high, and the path to full integration will be long and messy. Therefore, the verdict for you as an investor depends completely on your time horizon and risk appetite. For a short-term trader, the uncertainty around the swap ratio and regulatory approvals is a massive risk. But for a long-term investor who believes in the India growth story and has the patience for all the integration drama, this is a pivotal moment. You are watching the creation of a financial institution that will be at the absolute heart of funding India's journey towards becoming a developed economy. The success of this consolidation will be a powerful signal, not just for the power sector, but for the government's entire strategy of restructuring its public sector giants. The merger of PFC and REC is more than just a financial deal. It's a calculated gamble to build a war chest for India's future. It's a story of ambition, massive complexity, and very real risk. The vision is grand, but the execution will be everything. Now, I want to hear from you. What are your thoughts on this mega merger? Do you think the potential rewards outweigh the risks? And are you holding PFC or REC in your portfolio right now? Let me know your take in the comment section below. Thanks for watching.